Hi all, this is my second portfolio update on my new YouTube channel, Focus Freshman Investors. I'm going to be sharing with you my journey on the way to hopefully becoming an ISA millionaire and the investment strategies that I use. You will all see my ISA portfolio on a monthly basis with full transparency, meaning whether the portfolio is in the red or not, I will still be uploading the video. The markets have been turbulent in this past couple of weeks with tech sell-offs and fresh COVID-19 worries. Brexit has also been back in focus this week, which never seems to be good news for UK-focused companies, with my portfolio not being immune from the volatility. I've sold my stakes in EP2 and JD Sports with profits of £400 and £800 respectively. I sold my stake in EP2 mainly due to the current situation of the modern slavery which it is caught up in, and I feel the company doesn't fit my values anymore. And to be fair, ignorance isn't a good enough excuse for me. I sold JD for different reasons. After buying most of my holding at £4 per share, I felt it had returned to its full value without much room for further growth, taking a nice 80% profit. I've reinvested most of the cash into 3 stocks which I believe to be undervalued and quality companies with good growth potential. I'll be talking more about the stocks as I go through my portfolio in this video with you all. Before I get any further, I'd just like to say this doesn't constitute investment advice. These are more personal opinions and ideas. If you wish to do your own investing, please do your own research and consult a professional if need be. Anyway, once we've now finished with that, let's get on with this update. As you can see in the cover, I'm roughly about 0.2% down from my new investments that I've made in both portfolios. Today's not been too bad, 0.25% up. It's not really done anything today, it's just stayed still. But first of all, I've opened a stocks and shares ISA also, and that was due to the fact that I've filled up my lifetime ISA allowance for the year, so I can't invest any more money, put any more money into this account until April 2021. So I've opened a stocks and shares account now to put all my money, up to fill it up with more money until start of the next tax year, when I can reinvest money into my lifetime ISA. So first of all, let's look at the stocks and shares ISA. It's not a bad start. £83, 5% gain, £10 today. I'm only holding one stock in this. Is Distill. We spoke about this stock last month. Small cap quality company. Its earnings are increasing at a rapid pace. As Peter Lynch would say, earnings. I'm currently holding 50,000 units of this. And yeah, well, it's 8% in the first month, which isn't too bad. But hopefully, well, if it drops in price again, I can stockpile more units of this for hopefully a better return in the long term. Not very volatile stock, doesn't really move about too much. And then I've just invested in 2 funds, a global fund, Fundsmith Equity, which holds quality companies, and it's a concentrated portfolio, doesn't hold more than 28 positions. Basically what they do is they buy companies, quality companies, and they hold them and don't do much else with it. And they always give them, there has to be a reason for them to sell. And then, you know, sometimes it could be they found a better company and they want to buy that company, but they only ever have 28 companies. And it's got 10 years worth of returns, which is good, and it's outperformed the market for the last 10 years. So the second one is Lindsell Train UK Equity, which is run by Nick Train. And that also is a concentrated portfolio with only about 30 positions in it, and that also invest in quality companies. And they invest in these quality companies and then they hold them for the long term. So pretty similar approach, very Warren Buffett approach. So I'm happy with that, to just building this portfolio really, because you know it's not a lot of cash to deploy. £1,000 cash. I'm not going to be buying, you know, making massive positions in companies. So I'm starting off just building it with funds and maybe adding to this still at the moment, but not really looking to buy individual stocks in this portfolio at the moment because it's too small. And then the main account, which is the lifetime ISA, let's delve into this. My biggest position, my longest holding is Legal & General. It's not been the best month for Legal & General. It's been, well, let's have a look down for the month. If we look at the month graph, when it loads, the month graph is, well look, it was £2.38 at the start of the month, was it? And now it's gone down to just under £2 a share. But I have reinvested some of the money from the profits I took back into this as it was going down, probably around about, so I probably invested around about this mark first, then this mark, and I haven't invested any more at the moment. So, and it's got, you know, look, yeah, PE ratio is 6.5, so it's telling me it's a very undervalued and unloved company with an 8.83% dividend yield, which, you know, they've held the dividend. And it went ex-div on the 13th of August, and it will be payment will be made on the 24th, and it is £4.93 pence, same as last year. And it's one of the few UK dividend aristocrats that, you know, kept its dividend throughout the COVID-19 process, which is a good sign. And I just believe this stock's gone down this month due mainly to, you know, COVID-19 worries and Brexit, second lockdown worries and Brexit talks, you know, because it is heavily affected by UK, you know, politics and stuff like that, like Lloyds Bank and all the banks are. So hopefully I've brought, you know, I still believe I've brought it at a good price and it's a quality company for the long term. And, you know, at 8.83% dividend yield, I'm currently picking up £280 a year dividends from this stock, and which with another £50 due to be paid to me on the 24th, which will be reinvested back into the stock. So I'm not looking to put any more money in here at the moment, but I'm happy with the holding, and I think it's about 40% undervalued at the moment. So to be fair, I'm quite glad it's currently at £2 a share, because, you know, when my dividends are reinvested, I'm reinvesting it at a lower price, whereas if it was at £2.50, I'd be getting less shares for the dividends reinvested. So for the long term, it's pretty good. The second stock that I reinvested some of the profits into was Greggs. I didn't really buy these at a cheaper price than what I'd already bought them in at, but I brought them at about the same price. I think it's undervalued, and I think it's a quality business. And once it gets through COVID-19, see the last month here, once it gets through COVID-19, see, it's been pretty turbulent. 1 month. It's not 1 month, is it? Yeah, there we go. Started the month off at nearly £15 a share, and it's gone back down to £13 a share. So its PE ratio is 15 for a company like this. That's pretty good PE. Most companies like this have been roughly sitting on around about 20, 25. And I think once it gets through the COVID, it's been hit. The profits have been hit by the COVID-19 crisis, and its last update was 75% of pre-COVID sales back to, and it's got a third quarter update on the 24th of September. So hopefully we'll have more to talk about this stock in the next update. They've slowed down new locations and rolling out a delivery service, partnering with Just Eat. So we'll see how that affects the business going forward. But who wouldn't want a sausage roll and a donut delivered to their doorstep? I know I wouldn't mind one. My third stock, which I've got the most to talk about today, which I've reinvested some of the profits, is Hargreaves Lansdown. Now, Hargreaves Lansdown is a quality UK growth stock. It's got a decent dividend. It's currently sitting on a P of 28, but like, you know, its peak in 2019, it was sitting on a P of 40, so probably looking at a good price for this at the moment. It goes ex-div on the 24th with a special dividend of 17.4 pence per share and a final dividend of 26.3 pence per share. Even, you know, it was sitting at £18 a share a month ago as well, so even that's, you know, at a downward trajectory, but as you can see, it's starting to go back up again now. That's mainly due to Deutsche Bank's upgraded it to hold with a target price of £16 per share from £14.25 per share, and that says that it's down to its improved outlook, better justifies price, and full year 2020 results provide clear evidence of strength on Hargreaves Lansdown business model. And also, Bremenberg has updated to buy from hold. It's done an in-depth research into investment and saving companies and says they manage well for not income, so are more resilient to sustain earnings even with low GDP scenarios, job cuts and recessions. They carried out the survey of 1,000 UK platform users, which led it to be more confident in the long-term growth of Hargreaves Lansdown, which, you know, sounds promising. Also, its annual results were quite amazing. 5% rise in assets under management, 104 billion. Obviously, it charges a fee for its assets, so the more they've got under management, it's better for them. And the big one here is 188,000 increase in active clients. They now have 1.4 million clients, exactly 1,412,000 clients. That's what they want. I think that Hargreaves Lansdown is the biggest UK online brokerage platform, investment platform. It's got a switchy moat. Basically, like a moat is like an intrinsic characteristic that keeps it competition away. And the switchy moat means it's not something you switch. You know, I'm with Hargreaves Lansdown. I would probably not switch now, because it's just easier to stay with, you know, good quality service. So it has a switchy moat. So the more clients they get, you know, for the future, obviously charging trading fees, a percentage fee every month. That's good, only good for their future profits. And it's had a 27% increase in its earnings per share to 65.9 pence, which, you know, Peter Lynch says earnings always improve the price over the long term of the share and the company value. The company you know, and the Hargreaves Lansdown increased its dividend payment by 31% this year to 54.9 pence per share, which shows confidence, which shows the company's got confidence in its future, and shows strength, and is a great sign going forward. So I'm happy with this at the moment, and I think, you know, in the last, so even with the COVID crisis, a lot of people have signed up to investment platforms. A lot more people are investing their money and saving their money. So, you know, future-wise, it's looking for good growth in this company, and I think it's at a good price at the moment, because obviously it's been hit by the market crash, and it's not fully recovered. It's still 30 something % off its highs, so looking good. Obviously, I've got my government bond thing. That's just give a bit of balance and diversity to my portfolio. Just dollar cost average into this every month, and obviously, just if there is a crash, You know, hopefully it'll balance my portfolio out a bit more. And then Fundsmith equity, I've spoke about that in my last one, a dollar cost average into this one as well, and that just gives me a bit of global exposure, as I'm only invested into UK single stocks, as you know, I have a clearer view and I use these services more than their American counterparts. And then obviously I've got a position in Distill with 100,000 units. Hopefully this is going to be my big 10 bag winner one day. I believe in this company. It's got great financials, and annual, you know, financials are really good. You know, it's improving over 67% now. Obviously there's not as much going back, but you know, it's looking good at the moment. It's PE of 16 there, but now it's a PE of 26, so price obviously has increased. Not much to show, but I've done my own research into this stock, and I believe it to be a good future growth stock there for me. You know, it might, you know, sell some of its products, you know, to bigger companies and sell it on, make a big profit, and hopefully increase shareholder value. That's basically my main portfolio, my main investment portfolio. It's very concentrated at the moment. I've took bigger positions in companies than before, where I was putting £1,000, £500 in some companies, and you know, getting good returns on it. But the good returns, 100% on £500 is £500, 100% on £2,000 is 2k. So that's my thoughts on it. I'm not looking to make a quick buck. I'm looking for the long term, so I'm buying companies that I think are going to benefit me in the long term, that generate a bit of income via dividends and whatnot. So my biggest thing is with the online platforms, I'm constantly looking in, constantly checking every day to price movements and stuff like that. And sometimes it makes me think, oh, the price has gone down, you know, 2% today on my stock that I hold. Should I buy into more of it? But I think sometimes you shouldn't. Or my stock's gone up 5% today, should I sell it? And I think that's not good. You're looking at daily volatility, and I think what I'm going to do is I'm put a ban on myself from looking into these portfolios every day. So I'm not going to look into them for a month now. So the next update, I'll have only just looked at my portfolio to see, you know, it could go up, it could go down. I can't predict the future in the short term, but I'm not going to look for the next month, and then I'll make any decisions on buying or selling next month. Hopefully I won't touch it. Hopefully I'll leave it the same, whether it's up or whether it's down, unless things change drastically with individual companies. It should stay the same. So what I've done is I've set up some stop loss orders, no, limit orders basically. So if the price of Legal and General goes to 98p a share, which is bargain prices, probably looking, what was it, PE of about 2 or 3, and then, you know, a dividend yield of like 20%, which I don't think it will in the next 30 days, but I've put that there anyway, so I'll just grab £1,000 worth, load the truck with that price, and I'll be happy. Obviously my margin of safety prices for Hargrave, Lansdowne and Greggs, I've, you know, put £500 aside. If the price gets to that, they'll buy £500 into that. And then Distill, margin of safety price, put £1,000 into that. So that's where I'll allocate my money if it gets to them prices, so I don't have to do anything, just leave it alone. If it gets to them prices, then it'll buy. If it doesn't get to them prices, then my portfolio wouldn't have lost that much money anyway, or it's increased in value. So that's how I'm going to do it now. I'm not going to go in every day checking. And reasoning behind it is that, you know, I could be missing out on a bargain. But if I've got these orders set in place, and they're the prices that I should be paying for these stocks with a margin of safety, then I shouldn't need to go and check every day. And hopefully my portfolio will have a good month. Let's just see what Boris and everybody has in store for us, whether it be COVID-19 or Brexit. Let's try not to read the news too much either. I will still be looking generally at general articles on the companies I hold and companies I'm interested in that are on my watch list, but I don't think I'm going to be, I'm not going to be checking in on my portfolio every day, so I won't be checking in it until a day before my next update. I'll do my research and I'll give you an update on my portfolio, and hopefully all will be good and we'll be a bit more blue than red, but we'll see. And obviously Hargraves Lansdowne will be ex-dividend by then. Greggs will have an update, and Legal and General will have paid out the dividend, and the dividend will have been reinvested. So thanks for listening to me. Have a nice month. Have a nice September. All back at school, back at work. Hopefully everything will be a lot better next month regarding restrictions and Brexit and whatnot else. Keep on going on about Brexit, but it does my head in. So good evening, good night, peace out.